So let's get going then. It's 4 o'clock. Welcome to the monetary policy update in the fall of 2011. Per Jansson and myself will go through the arguments when it comes to how we look at what's going on in the Swedish economy presently and how we look at Swedish monetary policy. And the conclusion this time, the main conclusion this time is that we have postponed the increases in the repo rate, and there are two main reasons for that. First of all, as all of you are aware, there are all sorts of things going on when it comes to various countries dealing with their debt and particular government debt issues, and that creates a lot of uncertainty in the system, and that of course then tends to affect economic activity. Secondly, when it comes to economic activity in general, as far as we can judge, the numbers are coming in a little bit lower than what we expected in the past, and that also then implies that the inflationary pressure in the Swedish economy will be a bit lower than what we have expected so far. So for this reason, we did not see a need to change the policy rate this time, while on the other hand, the general level of the policy rate is still much lower than what one could consider to be some kind of a normal policy rate. So for that reason, and given that we foresee growth to eventually continue at a fairly sort of level and even rate going forward, it's still reasonable to continue to raise the rate in due course. Now, as all of you are aware, and this can be described in many different ways and by the help of many different graphs, this is just one of them trying to depict what has been going on lately. Happens to be stock market indices in this here. Could have been a number of other slides as well showing the same phenomenon, that stock markets have fallen quite dramatically in a very short period of time. And this reflects the uncertainty that's out there, and then of course this then in turn has an effect when it comes to people's wealth, and also it raises concerns about where the various economies are going. So that's one set of issues there, the turbulence in the financial markets. And this stems from the fact that there are major problems with public finances in a number of countries. There are two parts to this. One is all the discussions that are going on presently in the political field when it comes to how to deal with these issues. And presently that creates uncertainty because it's a bit unclear what actually will happen, when it will happen, and what the final outcome will be. Eventually, we think that these issues will be sorted out one way or the other, but this graph tells us is that were that to happen, then it will still take a long time before these problems eventually are solved. So this is something that we're going to have to live with for many years to come. Fortunately for us, this is not an issue in our country, but still this is sort of part of the background against which we have to work when it comes to all sorts of things going on here. And all in all, this also affects confidence abroad, and as you can see here, there is a declining confidence abroad. But having said that, I also think it's worth sort of pointing out that we come from fairly high levels. So in that sense, we're talking about kind of a matter of degree here, but still confidence matters, and it points towards slower developments in the future. At the same time, global growth is holding up reasonably well, and that particularly stems from the fact that there aren't problems in every country in the world, and there are a number of emerging markets, very large economies with that are doing continue to do quite well, and that means that global growth will remain roughly around 4%, which is actually a very reasonable number. And when it comes to Europe and the US, despite all the discussions going on presently about decision-making processes, how to deal with the debt issues and all of that, it's worth noting here that we still foresee growth in the US and in the euro area over the coming years. So we aren't really here talking about a recession. We're talking about growth a bit on the slow side when it comes to dealing with unemployment, but still growth in these economies nonetheless. And this is, of course, also something that matters for the Swedish economy, given that our exports are roughly 50% of GDP. Now, same thing here domestically. If we look at households and companies, you can see here that the confidence indicators are falling. They've been extremely high for a few years, but now they're coming down, and that's also in line with our projections that the economy will be moving a bit slower compared to what it has been in the past few years. So this is the picture that we get: slower Swedish growth, particularly slower growth in the short term. But on the other hand, we expect growth to sort of bounce back, and one way of putting it is to say that growth, as far as we can judge, is likely to hover around the average growth in the 2000s, the way we have sort of had it. And that's, of course, much lower than the very high numbers that we have observed in the past. But it's roughly where one would expect the Swedish economy to be under some kind of average circumstances going forward. And that's so in that sense, given that the Swedish economy is in quite good shape compared to a number of other countries, this is, as far as we can judge, a reasonable way of looking at it, because the Swedish economy actually can sort of perform better than many others when we don't have issues with the government debt to GDP ratios and a number of other issues to deal with. At the same time, a consequence of the slower growth is a slower improvement in the labor market, and we expect here unemployment to sort of slowly move towards somewhere around 7% during the period that we're looking at here. And this is also what one would expect, given the other assumptions that we have made when we do these projections. And when it comes to wage increases, the assumption we make here is that wage increases will be compatible with the inflation target. That's another way of saying that we expect wage increases to be roughly in line with what we have seen in the past 15 years. And this is of course an important assumption, because were that not to be the case, then on the inflationary side, things would start happening one way or the other, and we would need to react to that. But we have no reason presently to come up with a projection that is different from the one that we have, which is basically saying that we expect to be fairly close to the mean, the blue dotted line on this slide. And then what this implies when it comes to inflation is that we have low inflationary pressures presently. Situation is pretty much similar to what we've seen in the past, in the sense that on the one hand, CPI, including the interest rate increases that we carry with us, will be above the target of 2%, while on the other hand, CPIF without interest rate increases will be below 2%. And then CPIF will slowly move towards 2%. The way CPI is constructed with the interest rate component in it, it will actually take quite a while before these will coincide. So for the foreseeable future, what is most likely is a scenario where CPI will stay above or slightly above 2%. If you were to go also beyond 2014, 15, and so on. And given that this is where we are, but also given that the way we look at it, this is an interest rate level which still is lower than some kind of a normal level for the Swedish economy. On the one hand, there wasn't a need to raise the repo rate this time, while on the other hand, sooner or later we're going to have to revert back to raising the rate, so that eventually we get back to a higher level compared to what we have today. But as always, this is a forecast. It's not a promise. And as I've pointed out earlier today, if you look at the fan chart, and if you look at, say, 2015, you can end up anywhere between 0 and 7. So there's of course a lot of uncertainty in all of this. What is also different this time compared to earlier, when we have presented this the same fan chart, is that here presently one needs to add political uncertainty, and it's of course very difficult to make projections about that compared to just arguing about the cycle and where we are in the cycle and what the cycle implies for the level of the policy rate. So that's one additional factor that makes it even harder than usual to judge eventually what will happen going forward. But nonetheless, this is our best judgment as of today when it comes to judging where the policy rate should go over the next few years. So all in all, the repo rate increases have been postponed. Eventually we will get back to them. This rests on two major assumptions. First one is that eventually the political uncertainty that we're living with presently will be sorted out in such a way that over time the debt issues will be dealt with. That's not saying that there will be immediate clarity, because there will of course be many ups and downs when it comes to this over many years to come, but at least to clearer see what will be done and how it will be done. We do this on the assumption here that this will actually happen, and take some comfort actually in the fact that in the case of Iceland and Latvia, they don't deal with the fund anymore. And Ireland is on the right track when it comes to their IMF program. So that's just saying that these things are actually doable and can be done, and it has happened before. And then the second assumption, which is important for all of this, is also our assumption that the wage negotiation round that we have ahead of us during the next, let's say, 12 months will be sort of normal, in the sense that wage increases will be in a range which, together with productivity increases, is acceptable when it comes to the inflation target. If these two things were not to hold going forward, then we probably would have to start over again when it comes to how we think about these things. So, thank you. Questions, reflections on this?
Unmuted.
Regarding your last assumption here, the wage negotiation, we have this week actually received a demand from the trade unions both in the LO and also the trade unions in the industrial sector, and their demand seems to be a little bit higher compared with your wage increase assumption here. Do you think it could be, and we also have seen that the expectation among workers are high. Do you think there can be tough and difficult negotiations this time?
Well, aren't negotiations always difficult? We weren't party to those negotiations, so we'll see. We'll see what eventually will come out of it. On the other hand, what we show here and the way we have reflected on this is that that we are going to go through a period where growth will be lower than what it has been in the past, and that's also something that one should factor into the equation. More questions, reflections?
Yes, I must say that the impression I get is that there is still a big lack of a sense of urgency about what's going on in the Eurozone especially, that it will be solved, quote, one way or another. I don't think cuts it. You know, this is a crisis that is in the end game right now, and things won't just be solved one way or another. I think we really need to think harder about this and what the consequences may be. And I think that the idea, as I read it in your statement today, that once fiscal policy is dealt with, the debt problem is dealt with in the US, confidence will return and demand will improve in the US. Now, I don't think demand is weak because there is no confidence in the US debt trajectory. 10-year Treasury is below 2%. I think there is simply no demand, and if there is more contractive fiscal policy, that will inflict more pain and a deeper contraction. So I still think it's very rosy, and I do wish that you somehow could, you know, more elaborate on your ideas on how the Eurozone crisis will be solved, what these ways or another really are.
I mean, one way or the other, as you say, and as I pointed out earlier, these problems will take many years to fix. So in that sense, this is something that all of us will have to live with, because we know that in this country it took us many years in the 90s to deal with all the issues that we had to deal with then. But still, one needs to be mindful of the fact that the world is not only Europe or the U.S. and in a number of countries it's not all that bad after all. Of course, there is a probability that things would end up being completely different compared to what we are talking about here. But when if that were to happen, we'll deal with it when we pass that bridge.
If I also maybe can say to clarify maybe a little bit that it's not, as Stefan said, it's not an assumption that suddenly a couple of nice decisions will be taken and then everything's perfect. It will certainly be a gradual process where one first has to show some political strength, I guess, to calm down the kind of acute turbulence going on. And then certainly these countries need to reappear and do more and more. That's the usual, I guess, process we see also when the fund deals with countries, that they do something and then it's not enough. They have to reappear. But one step in this, in my mind, has to be something that puts some confidence in the markets. Otherwise, it will be quite difficult to work in a situation where the stock market goes up 5%, then down 5%, and like that. So, but it will certainly be a multi-annual process where things have to be gradually readjusted so as to regain strength and confidence in the future.
But let me add to that if you look at the Swedish numbers and the way we have looked at it and done them in at this particular juncture, as far as we can judge, exports will still continue to grow. We will have a sizable current account surplus for the foreseeable future, and the budget will be in surplus. And there's not a lot of inflation pressure in the system as a whole, and the debt to GDP ratio on the government side is very low compared to most other countries, and that's of course a very good position to be in compared to where many others are, and that is a favorable position to be in, given that global growth is here to stay, despite the fact that of course you have all these issues to deal with in other parts of Europe.
Well, this debt crisis in Europe has led to a banking crisis as well, because everybody is trying to figure out where the debt is hidden, so to speak. And we've seen the LIBOR spreaders widening and the iTraxx index go to new highs, and bank stocks being sold. Fortunately, we haven't seen that in Sweden as of yet. There are small signs. We can see the mortgage spreads, but a little bit on the OS STIBOR spreads. What is the readiness from the Riksbank if this situation would worsen?
Well, if that were to happen, which, as far as we can judge, is not in the cards, then we'll deal with that day. And if you look at what we were prepared to do in the past and related to the size of the economy, we did not hesitate. So we are, of course, like many others, closely watching what is going on. Now, looking at it from sort of our perspective, first of all, the banks aren't really much exposed to Southern Europe. So in that sense, it's hard to find a direct link to what is going on there. If things start happening elsewhere, then given that, of course, Swedish banks are quite dependent on funding in euros and dollars, we're talking about secondary effects, some kind of a second round effect that comes towards us because it passes through a number of other banks before that happens. It's hard today to see that there would be a shortages of euros, at least not in the short run, because I mean the ECB is putting plenty of money into the system, and then the other part that people are debating presently, that's the part dealing with dollar funding. But when it comes to dollar funding, if you look at our banks, they have a very high capital adequacy compared to many others, and given that they're hardly exposed to what's going on, directly exposed to what's going on in Southern Europe, then that essentially means that if you order the banks in the world and those who borrow in dollars, our banks come very high up on the list because they don't have the problems that a number of other banks have. And adding to that, if you look at credit losses, I mean that's not an issue today, because the credit losses, given that the Baltic issue has been handled, and that has happened already, has been sort of parked over there and is being dealt with, the Swedish banks compared to many others are actually in a quite favorable position. That doesn't mean though that they would never ever be affected by anything, because clearly if there were to be problems on the euro side or problems on the dollar side, then eventually that would also sort of find its way into our system. But then we would be ready to deal with that. I don't know if anybody's listening in at all over their phone, but you're free to ask as well. Okay. If there are no other questions or reflections or comments, then on our side. Hello?
Sorry.
Yeah, sure.
Thomas from Morgan Stanley. Sorry, the connection is really bad. I just wanted to ask you about the long-term inflation expectations, because I guess all the other questions that I wanted to ask were already answered. What about the long-term inflation expectations? They picked up in the past. What if they pick up again on the September 14th? Would that, in addition to wage runs, play any role for you, or?
That has been a concern, and we've dwelled on that, I guess, in the two last reports or so, and where the problem might be that if wage expectation and inflation expectations would maybe emanating from the high present CPI figures would feed back onto core inflation, that might cause a problem. But what we see now is some slowing down in these expectations, I guess, at all horizons more or less, and also now as sort of the economic situation looks a bit, I mean, the economy is growing a bit slower ahead, then I would guess, that it's not that urgent anymore. So the expectation is that those expectations probably would decline further a bit as we look into the autumn.
I mean, let me add there that given that those expectations are quite closely correlated to the present CPI, And given that despite the fact that the CPI is above target, given that it's going to come down, then if things continue to evolve the way they usually do, then that should mean that inflation expectations also will gradually come down. Of course, if that were not to be the issue, if something completely different happens so that they start picking up and going up, well, then we move into new territory, and then we would have to factor that into our thinking and perhaps reconsider.
Also, maybe if you look at the dynamics of these inflation expectations, I mean, they've been high, but they also pretty well follow the usual historical pattern that they have sort of displayed historically. So in a sense, they haven't been surprisingly high given the fact that CPI has been pushed up by the interest rate increases.
Thank you.
Okay, any more questions? If not, thank you all for coming and spending some time together with us. Thank you. Lägga på. Någon gång i tiden.